Imagine intentionally shutting down production at your absolute best facilities, right? Just watching the market price for your core product completely crater.
Sounds like a nightmare, honestly.
Right. But then somehow you walk away with like $60 million more in profit than you did the year before.
Hmm.
Welcome to today's deep dive.
Glad to be here. Because the contrast in the data we're looking at today is, well, it's truly bizarre.
It really is. So we are taking a dense stack of Q1 2026 financial and operating reports from Advantage Energy Ltd., and we're pulling out the essential lessons for you. The promise here is a shortcut to understanding how a modern corporate giant doesn't just, survive extreme market chaos, but actively engineers a way to profit from it.
Yeah, you have a company dealing with the total collapse of their local market, yet their financial statements look like they are operating in a boomtown.
Which is exactly why we are bypassing the dry accounting spreadsheets today.
Yeah.
We want to get to the actual mechanics. We want to understand those aha moments.
Right, the real strategy.
Exactly. Like, how does a company keep its debt completely flat, turn a massive profit swing, and fund a world-first environmental tech project, all while the core price of natural gas is basically falling off a cliff?
Well, to start, we really have to look at the macroeconomic backdrop for the first quarter of 2026, because it is a masterclass in extreme volatility.
Set the stage for us.
So the global situation is entirely split. If you look at the international stage, oil prices spiked significantly. The sources point to intense geopolitical tensions in the Middle East specifically, conflicts involving the U.S., Israel, and Iran.
Which obviously disrupts major global energy supply chains.
Exactly. And when supply chains are threatened, markets get nervous, buyers stockpile, and suddenly the price of a barrel of crude just shoots up.
Okay, but then you zoom in on Western Canada, right? Specifically the local natural gas market, and the picture is completely inverted.
It's an entirely different universe. Western Canada experienced an incredibly mild winter, and usually winter is peak season for natural gas because it's heavily used for residential and commercial heating.
People need to heat their homes.
Right, but when the weather stays warm, people simply don't turn their furnaces on.
I mean, all that gas just sits there.
It just sits in storage facilities. And the problem with natural gas, unlike crude oil, is that it is notoriously difficult and, well, expensive to store.
Yeah.
So once local storage in Alberta fills up, the pipelines act like a garden hose attached to a fire hydrant. The pressure builds up. The local trading hub, which is known as AECO, becomes massively oversupplied.
And prices plummet towards zero.
Literally towards zero.
So Advantage Energy is caught in the middle of this. High global oil prices, but crashing local gas prices. Yeah, the numbers in their Q1 performance reports are staggering when you consider that context.
They really are.
I mean, they generated over $118 million in operating cash and an adjusted funds flow of just over $121 million. But the most surprising detail is their net income.
The net income is wild.
They posted a net income of $29.5 million this quarter. But if you look at the exact same quarter last year, they posted a $29 million loss.
A nearly $60 million positive swing during a period when their local market was effectively broken.
Okay, let's unpack this. Because you don't magically flip a $60 million deficit into a profit by just crossing your fingers.
Yeah.
How do you insulate a company from a local market crash?
You build a financial and geographic fortress well before the crash actually happens. Advantage looked at the local AECO market and recognized a structural vulnerability.
Makes sense.
Relying entirely on Alberta to buy your gas when Alberta is drowning in gas is, a recipe for bankruptcy. So they systematically dismantled their exposure. For the remainder of 2026, only about 18% of their natural gas production is exposed to that local AECO pricing.
Wait, just 18%? That leaves 82% of their gas completely shielded. Where's it all going?
They are physically piping it thousands of miles away, and they're using complex financial contracts to lock in prices in other jurisdictions. Yeah, they've secured pipeline capacity to transport their gas to Empress at the provincial border, to Emerson down south, to the Dawn Hub in Ontario, and all the way into the heavily populated Chicago market.
I did notice in the reports, though, that this strategy isn't free. Their transportation expenses are substantial, hovering around $3.94 per barrel of oil equivalent.
Right.
They are paying a heavy premium just to move the product.
It costs a premium, absolutely, but the arbitrage makes it incredibly lucrative. Let's look at the mechanics of that trade. The U.S. Midwest actually experienced some cold weather snaps this quarter.
Oh, interesting.
Right. So by paying that 3.94 transportation cost to get the gas out of warm Alberta and into chilly Chicago, they generated $32 million in incremental revenue.
32 million.
Yeah, above what they would have made dumping it onto the AECO market. They spent millions to make tens of millions.
That makes intuitive sense.
Yeah.
Moving a physical product to where the physical demand is. But there was one detail in the marketing update that blew my mind. They aren't just selling gas to other places, they are selling gas disguised as electricity.
That's a great way to put it.
The report highlights a contract tied to the PJM spark spread. We need to explain how a company pulling gas out of the dirt in Canada is making money off electricity prices in the eastern U.S.
This is perhaps the most elegant financial hedge in their entire portfolio. So PJM is a massive regional transmission organization. It coordinates the movement of wholesale electricity in all or parts of 13 eastern U.S. states.
Okay, huge market.
Huge. And the spark spread is a financial term. It represents the theoretical gross margin a gas-fired power plant makes. You take the price they can sell a megawatt of electricity for, and you subtract the cost of the natural gas they had to burn to create it.
So Advantage is essentially saying, we will supply the natural gas, but we want a cut of the profit you make when you turn it into power.
That is the exact mechanism. They have a long-term contract running through 2035 to deliver natural gas, but their payout is directly pegged to the PJM electricity price.
That is so smart.
When the eastern power grid gets stressed, maybe everyone turns on their air conditioning, or a cold snap hits electricity prices skyrocket. Even if the raw price of natural gas doesn't move much, Advantage captures the upside of the power market.
Insane.
In this quarter alone, they realized a gain of over $6 million just on that single embedded derivative contract.
And this is why this matters to you, the listener. If you run a business, invest your savings, or even just manage your career, relying on a single local market or a single skill set is a massive hidden vulnerability. Advantage used geography and sophisticated financial contracts to build a firewall around their revenue.
Exactly.
But financial armor only deflects the blows. At a certain point, a financial contract expires.
Hedges always roll off eventually. You can't just play defense forever. You have to adapt your physical operations to match the reality of the market.
Here's where it gets really interesting. In this Q1 report, there's a statistic that almost reads like a typo. Liquids, meaning crude oil, condensate, and natural gas liquids, only made up 15% of Advantage's total production volume. Yet those liquids generated an enormous 44% of their total sales.
It highlights a massive disparity in commodity value, right? 15% of the physical volume is driving nearly half of the entire revenue stream.
But I have to push back a bit on the operational reality here, because if I look at that math, my immediate thought is, well, stop drilling for gas and go drill for oil.
Sure.
But an energy company isn't a software startup. You can't just push an update and change what your factories produce. We are talking about massive steel rigs, complex environmental permits, specialized geology crews. How agile can a massive industrial operation actually be? Can they just change targets on a dime?
They absolutely can, provided they have built a deep inventory of options in advance. The sources detail that Advantage is actively reallocating $25 million of their capital budget right now, in the middle of the year.
Middle of the year.
Yep. They are stripping that capital away from their Glacier gas targets and redirecting it entirely into their Wembley oil targets.
But how do they physically do that without ruining their annual production targets?
Because they aren't starting from scratch. Modern drilling operations maintain a queue of DUC's drilled but uncompleted wells, or they have permitted survey-ready locations waiting in the wings.
Okay, so they're prepped.
Exactly. They simply reroute the completion crews and the heavy machinery to the oil-rich zones to chase that higher global crude price we discussed earlier. And the crucial takeaway from the reports is that they are executing this $25 million pivot without changing their overall 2026 production guidance.
That's wild. They are essentially swapping the flavor of the energy they produce while keeping the total volume steady. But doing that requires massive processing power behind the scenes, right?
Oh, absolutely. Yeah. Processing power is the bottleneck for most energy companies. You might be able to drill for oil, but if you don't have a facility to separate the crude from the water and the associated gas, it's useless.
Just stuck in the pipe.
Right. So Advantage has been methodically overbuilding their infrastructure. The reports note their new 75 million cubic feet per day Progress gas plant is mechanically complete. At the same time, they are voluntarily initiating a 21-day planned turnaround at their main Glacier plant in the second quarter.
Okay, let's clarify what a turnaround means in this context for everyone listening.
Yeah.
They are taking their biggest asset completely offline.
A turnaround is a massive, scheduled shutdown for deep maintenance, infrastructure integration, and system upgrades. It is going to temporarily hammer their production numbers in Q2.
Oh,
But they are making a strategic sacrifice. Once both the Progress and Glacier plants are fully integrated and brought back online, the economies of scale take over. The company projects their operating costs will plummet to around $5 per barrel of oil equivalent.
$5 to extract, separate, and process a barrel's worth of energy. With oil prices sitting where they are, the profit margin on a $5 operating cost is staggering.
The efficiency allowed them to push production to 90,000 barrels a day for the second half of the year. But to truly understand their strategy, we have to look at what they are intentionally leaving behind.
You're talking about the Montney gas wells.
Yeah. The sources highlight a fascinating piece of industry data. Of the top 12 producing Montney gas wells drilled in all of Alberta in 2025, Advantage owned 9 of them.
9 out of 12.
They possess some of the most prolific, highest-yielding natural gas assets on the entire continent.
And yet, they are actively choking them back. What does that literally mean, to choke back a well?
Well, when you drill a well, you are tapping into a high-pressure subterranean reservoir. The gas wants to rush to the surface. To control it, companies install a network of heavy-duty surface valves, literally called chokes.
Okay.
By adjusting these valves, you restrict the diameter of the pipe, basically bunching off the flow. Advantage is tightening those valves on their absolute best wells.
They're using the earth as a free storage tank.
It is the cheapest storage facility in the world. Instead of producing world-class gas just to sell it into a crashed local market for pennies, they hold the pressure in the reservoir. They preserve the asset.
Wow.
They aren't emotionally attached to their identity as a natural gas company. They are a margin company. They produce whatever molecule offers the highest return on capital at the exact second.
So we have the first 2 pillars of their strategy. They use global financial contracts to protect themselves from local price crashes. And they use physical agility to pivot their heavy machinery toward oil when gas is cheap. That solves the chaos of 2026.
Right.
But any deep dive into the energy sector has to confront the permanent existential pressure hanging over the industry, which is carbon emissions.
You can outmaneuver a mild winter with a pipeline to Chicago. You can pivot to oil when the Middle East gets tense. But you cannot hedge against a global systemic shift in how the world penalizes carbon emissions. That is a permanent change in the atmospheric reality of business.
Which brings us to a fascinating entity mentioned repeatedly in these financial reports, Entropy Inc. And the best way to visualize Entropy, based on the source material, is to imagine a high-tech, clean energy startup operating out of Advantage's basement.
I love that.
Is using Advantage's house, but is being bankrolled by outside billionaires.
That's a highly accurate structural analogy. Entropy is a subsidiary focused entirely on carbon capture and storage, or CCS, and they have secured a massive $500 million capital commitment from Brookfield and the Canada Growth Fund. The sources indicate over $310 million of that has already been drawn down.
The financial structure of this relationship is what really stands out to me. Advantage currently owns 92% of Entropy, but Brookfield and the Canada Growth Fund are pumping hundreds of millions of dollars into it through instruments called non-recourse unsecured debentures.
Yes.
Let's translate that into plain English.
It sounds like dense financial jargon, but the mechanism is actually quite simple, and it's brilliant for Advantage. A debenture is a type of debt alone.
Okay, a loan.
Unsecured means there is no physical collateral backing it. So if Entropy defaults, the investors can't seize Advantage's pipelines or gas plants.
Got it.
And non-recourse means the investors have no legal right to go after the parent company, Advantage, to get their money back.
Wait, so Advantage gets to incubate a $500 million environmental technology company, and if the whole thing implodes, Advantage's core oil and gas business doesn't lose a dime. The risk is completely isolated.
Advantage provides the testing ground and the technical expertise, while the outside investors shoulder the financial risk. Now, there is a trade-off.
Of course.
If Entropy succeeds, and those outside investors decide to convert that debt into equity, meaning they take an ownership stake instead of just asking for their money back, Advantage's ownership of Entropy drops from 92% down to roughly 35%.
They are giving up a massive slice of the future pie in exchange for someone else buying all the expensive ingredients today.
Exactly. But look at what those ingredients are building. During that 21-day scheduled turnaround at the Glacier plant we discussed earlier, the one taking production offline Entropy, is integrating its Phase 2 carbon capture project directly into the facility.
What does that actually look like on the ground? Like, how do they capture the carbon?
They are implementing what is called post-combustion carbon capture. When the gas plant burns fuel to run its operations, the exhaust called flue gas normally travels up a smokestack and into the atmosphere.
Right?
Entropy intercepts that flue gas. They route it into a massive absorber column where liquid chemicals, typically called amines, rain down inside. The amine molecules act like a chemical sponge.
A sponge.
Yeah, binding directly to the CO2 in the exhaust while letting the harmless steam and nitrogen escape.
So they are literally scrubbing the exhaust before it leaves the building.
They then take that CO2-rich liquid, heat it up to release the pure carbon dioxide, compress it into a dense fluid, and pump it deep underground into secure geologic formations.
That is incredible.
When this Phase 2 project is mechanically complete in mid-2026, it is projected to reduce the glacier plant's total emissions by over 85%.
Over 85% of the emissions just erased from the ledger.
It will be the world's first gas processing plant with integrated post-combustion CCS on all major sources of emissions. They are turning their biggest existential liability, their carbon footprint, into a highly managed proprietary technological process.
However, looking through the sources, this journey isn't without its speed bumps. There is a very specific, detailed update in the report regarding the federal government's carbon capture, utilization, and storage investment tax credit.
Yes, the intersection of corporate innovation and regulatory frameworks is heavily featured here.
And to be absolutely clear to you listening, we are not diving into the politics of this at all. We are impartially reporting the friction point between capital deployment and government policy exactly as it is stated in the company's financial documents.
Right, just the facts from the report.
So, the sources outline that Advantage and Entropy have been actively spending money and incurring eligible costs for these carbon capture projects since 2022. But they are still waiting on the actual receipt of the federal tax credit.
The reports explicitly state that while the company has engaged constructively with multiple federal departments, the progress has been significantly slower than they anticipated. A major piece of legislation, Bill C-59, which actually implements the tax credit, only recently received royal assent. Advantage is now working with the Canada Revenue Agency to finalize their specific tax credit amounts.
And the company takes a very clear stance in their report regarding the broader market implications of this delay. They express concern that this slow pace might negatively impact the ability of companies across the country to confidently invest in Canadian emissions reductions.
It perfectly illustrates the inherent tension in industrial transitions. You have a highly agile corporate entity that can pivot $25 million from gas to oil in a matter of months and engineer a world-first carbon capture facility. But that speed slams into the necessary, often grinding pace of federal legislative and tax rollouts. The timeline of a boardroom simply doesn't match the timeline of a parliament.
And the sources note that whenever those tax credit proceeds do finally arrive, Advantage has earmarked them to go straight toward debt reduction, further fortifying that financial balance sheet we talked about at the beginning. So what does this all mean? We've looked at the geographic hedging, the physical pivot from gas to liquids, and the incubation of a carbon capture subsidiary. Advantage Energy clearly isn't just a company that digs holes in the ground and hopes for the best.
Not at all. They're managing a highly complex, multivariable puzzle. They use the PJM power grid in the U.S. to hedge against mild weather in Alberta. They choke back their world-class gas wells to save the resource while shifting their heavy machinery to pump oil. And they use outside capital to build carbon capture tech, mitigating the biggest threat to their industry's survival.
I think the underlying lesson here extends far beyond the energy sector. Whether you are managing a household budget, running a local business, or navigating your career path, the core concept here is the immense value of optionality.
Optionality is the ultimate armor. Advantage didn't wait for AEK gas prices to crash to figure out how to lay a pipeline to Chicago. They didn't wait for a global carbon penalty to become unbearable before they started experimenting with amine scrubbing.
They prepared.
They built the alternatives when times were stable, so they had levers to pull when the chaos hit.
When you aren't forced to take the single price or the single path the market hands you, you control your own destiny. You can shut down your bag factories and still make a profit. Which leaves us with a final, lingering thought to chew on. As we watch companies like Advantage diversify financially, pivot their physical operations seamlessly between commodities, and incubate world-first environmental tech, we have to rethink our definitions.
The definition of what makes an energy company valuable is fundamentally shifting.
It makes you wonder, looking 5 or 10 years down the road, will the truly successful, dominant energy corporation of the future be defined more by the commodities it manages to extract from the Earth or by the carbon it manages to put back in? Thanks for joining us on this deep dive.